Do you remember the Tesla bull run? The one where the stock tripled in its price in just a couple of months? Where everyone was declaring that this was Tesla finally getting its break and it was finally going to be able to take over the world? Well, we just reached December 2019 levels just a month after that. Hey everyone, my name is Jack, and if you bought Tesla stock about a month ago, you would be facing a 60% loss on your money if you held to today, March 18th. Meanwhile, the S&P 500 has lost 30% of its value in that same time period, meaning that if you bought Tesla rather than just a broader index, you would have twice the amount of losses. Tesla's recent stock swing shows the difficulty and the uncertainty that comes with picking stocks. A stock can be subject to incredibly violent price swings at seemingly random times for seemingly any reason whatsoever. Perhaps even worse, a random market event, like a pandemic, can threaten a company's very existence just by the uncertainty that it brings. Before we take this any further, I have to emphasize that I am not a financial advisor, and this video should not be taken as financial advice. I do not want to get in a lawsuit with someone who happened to come across my video online and then bet their entire life savings on something that I may have said out of context, and then will ruin themselves, and then will try to get money off of me. I'm just some guy. Please don't sue me. I really don't want to get in a lawsuit. Thanks. But leave a like. While Tesla is no stranger to large stock price swings, and they'll probably pull through this in the long haul, many investors' portfolios have been ruined by this move because a large number of first-time investors bought into Tesla during its historic rise, and they're now facing the pain of a company stock crash in the midst of a much larger market crash. The Tesla debacle also shows the importance of having a well-diversified portfolio. There are two types of risk that an investor faces whenever they make an investment, and that's specific risk and market risk. Specific risk is the risk that an industry or a specific company will do poorly, whereas market risk is the risk that the overall market will do poorly. Market risk is practically unavoidable, but specific risk can be reduced significantly by diversifying. Since specific risk in one company is typically not going to be the same in every other company, since every company has its own specific risks, and diversifying your portfolio with a bunch of different companies, all with their own different risks, should essentially cancel them out. You can think of it this way. The more different companies you have in your portfolio, the less we would expect one of those companies' failures to destroy the rest of that portfolio, since every company has its own specific risk. As an example, mighty Amazon has done much better than Tesla during the same 1 month drop, since Amazon has only lost 16% of its stock value as opposed to Tesla's 60% drop. Amazon is exposed to different risks than Tesla is. Tesla is an electric car manufacturer. An electric car manufacturer is going to have very different risks, especially given the size of the companies, as opposed to a large distribution firm like Amazon, which focuses on distributing smaller consumer items rather than larger electric cars that they actually manufacture in-house. Having different types of risks in your portfolio will prevent one of them from destroying the value of the entire portfolio should something go wrong in one company. For example, if there's a world shortage of cardboard boxes, that's a risk that Amazon's going to have to face, and that they will be unable to ship anything if there suddenly aren't enough cardboard boxes to go around, since I would imagine that Tesla is not putting cardboard into its cars. If it is, that's probably a problem. But we'd expect that to affect Tesla very differently than it would to Amazon, if it affects Tesla at all. But there are all sorts of very specific risks that are associated with a company or a type of company that won't be applied to a different company with an entirely different business model or different product. If you have a large number of companies in your portfolio, we wouldn't expect one of those companies' specific risk to upend the portfolio, assuming that that portfolio is well balanced. This is where index funds come in. Index funds allow you to invest in hundreds, if not thousands of companies all within one fund to eliminate that specific risk. For example, the Vanguard Total Stock Market ETF takes 3,500 different companies and puts them all into one fund. And then you buy one share of that fund just like any other stock. Only within that one share are thousands of different micro shares of all of those companies. This gives you incredible diversification with very little effort. And then any one company's failure within that fund will be made up for by thousands of other companies. But you are still always exposed to market risk, like the pandemic and potential recession that we're facing today, to where even the Vanguard Total Stock Market Index is down 30% despite having thousands of its companies under its belt. We can confidently say that market risk has caused that 30% dip, since the amount of companies and different industries within this ETF mean that specific risk is all but eliminated. What does this mean for you, the investor? As you probably know, the higher the risk that you take, the higher the reward that we would expect at the end. If you're taking on lots of specific risk, we'd expect the ceiling on your investment to also be much higher. However, that goes the other way in that the floor is much lower as well. Conversely, if you're diversifying and you're eliminating that specific risk, we would also expect the ceiling on your investment returns to also be lower. And the return without specific risk that you've probably heard before is about 7% to 8% on year. That's what the stock market returns on average each year. The likelihood of you beating that 7% to 8% average number over the long haul with a well-diversified portfolio is very slim. But you will have far more consistency in reaching that average return if you maintain that diversified portfolio over the long haul. Even if you hit a home run on one stock, the recent Tesla bubble shows how delicate that situation can be. Not to mention, when you're picking stocks, you still have to weigh whether or not you should hold out the stock or to sell it and take the gains now. Or maybe you sell now to cut losses and then you see the stock rise aggressively over the next week. You never really know in the short run with stocks. And even with a well-diversified portfolio, you're going to see some swings in the short run. But when you're buying something like an index fund that's well-diversified, it's more of a fire and forget approach. You buy the diversified asset and then hold on to it for the long run, and you would expect to see that 7 to 8% index return on average each year. And when you're picking stocks, you might not have a company that lasts that entire span. Even if it does great in the next couple years, if you're holding it for 15 years, the company might get bankrupt or completely change in that time. You never really know when you're picking one specific stock. But when you have the whole market under your belt, you know that generally, given the history of the stock market, it's probably going to go up gradually on average over the long haul. And if you guys are looking for a new brokerage or you just want to check one out, I highly recommend taking a look at M1 Finance. I actually have a series documenting the portfolio I'm building in it. It has one of the nicest interfaces in the entire industry in that it shows your allocations in this cool little pie chart sort of thing. You can also borrow against your portfolio, and it makes researching stocks very easy as well. You can divide them by dividend yield, whether it's domestic, whether it's bonds, whether it's a fund. You can really break it down very easily and really build a portfolio that fits your exact investing needs. I highly recommend you at least give them a look. I have a link in the description if you're at all interested. They are a free brokerage with no commissions on any trades, just like a lot of the other free brokerages out there. And they let you invest in fractional shares as well as a bunch of other perks. Definitely give them a look in the description below. So unless you believe that the stock market is going to collapse sometime soon, if we can rely on history, then we could see that the stock market should keep doing what it's been doing for over 100 years now, and that's producing gradual returns on average each year, as opposed to picking stocks, which has a lot more risk, potentially more reward as well, but a lot more chances to lose all of that money too. In short, diversifying your portfolio is a fundamentally consistent and strong way to prevent against massive losses like the ones that we saw with Tesla in just this past month. You eliminate specific risk and only expose yourself to market risk. And this should bring much more consistent returns over the long run with far less losses as well. Well, that's all I got today. If you like this video, be sure to give it a like as it helps the channel out a lot. If you like this sort of content about investing, I have more videos on real estate and other personal finance topics, so be sure to subscribe so you don't miss any updates. If you like stock investing in particular, I actually have an update on a portfolio that I'm building in M1 Finance that I put out every single month, so you can see how my investments are doing and how my stock picks, or really my broader diversified portfolio, is doing over these many months where I'll be building it. Last thing I want to mention, I actually have 2 links in the description if you don't have accounts with them already, but you can get some free stocks by opening accounts with Robinhood and Webull, which are 2 free stock trading platforms that can allow you to go buy some broader index funds or start picking stocks if that's your style. But either way, if you just open an account with them, put some money in, even if you don't trade any of it, they'll give you some free stocks, and then if you still just want to close your account after that, I won't tell anyone. You'll get to keep the stock, and then everyone's happy. But whenever you're investing, just be careful, as a lot can happen in a very short period of time, as this last month has definitely shown us. But until next time, take care.